Well, great. Welcome, everybody. It's the next edition of the Maslow Barside Chat. We thought we'd try something slightly different today. And as you guys know, I'm Matt Jakimiak, the CIO. But today we have somebody new, Isaac Thompson, who is our portfolio manager. And so most of you probably don't know Isaac yet, but we're going to change that. He's going to get out and start meeting with some folks. But he's been with the firm now for about a year. By way of background, he joined us from a family office here in town called Moon Tower Partners, where he was very focused on alternative assets like private equity, private real estate, and venture capital. His educational background, he went to TCU and started working in Dallas and then came down to Austin as quickly as he could because he knew Austin is great. So with that, maybe I'll turn it over to Isaac because I know he's been spending a lot of time meeting with managers and talking to our advisory team, and he's got some themes that I think we want to talk about today.
Yeah, absolutely. Thanks, Matt. And it's been great to be part of the Maslow team, and I've really enjoyed my time here. Across the manager conversations we've been having, the common themes seem to be inflation and interest rates. And I'm curious what you're looking for across the investment horizon.
Yeah, sure. Yeah, and I think those themes that you're talking about, in inflation in particular, I think they kind of spill into two main things. The way that I'm thinking about it is, how's inflation impacting what the Fed is going to do, and this concept of higher for longer. So inflation in particular, I think we're now at that point where the Fed has done probably everything that they're going to do from a Fed funds rate. We're now at 5.25, 5.5, somewhere thereabouts, depending on how you want to look at it. And the expectation was hopefully that we could get some interest rate cuts this year, but unfortunately inflation's been kind of sticky in here. And so we're now at a point where the Fed feels like the economy's still strong. If we look at unemployment numbers, wage growth, and the like, and inflation is suggesting that all the Fed activity has put at least a ceiling on inflation, but it hasn't stopped it. And we're still growing at a little bit higher rate than we would like it to be at. And so the Fed is less inclined to cut interest rates. So coming into this year, the expectation was that the Fed may cut somewhere around 6 times, 25 basis points each. Now we're down to around 2. And I think if we talk to some of our managers, we're now at a point where they're thinking that those 2 may not even happen this year, especially when we think about some of the bigger activities that are going to happen from here to the end of the year, which include an election that's going to be really, really interesting. So I think from our perspective as an investment committee, we think inflation is going to be persistent. I don't think that that's going down anytime soon. And it's going to be higher for longer from an interest rate perspective. Now, with that in mind, I know you've been spending a lot of time talking with managers and specific strategies. If we put that in the context of the way we're looking at portfolios, what do you think the implications are to those managers and strategies with that framework?
Yeah, absolutely. I mean, I think the big thing with the higher rates is it's put a real damper on the M&A market. The volume of transactions is down significantly. You're seeing managers delay, extend their funds. You're seeing banks push back maturities. And so the lower transaction volume is primarily due to the higher interest rates. And the way that kind of plays out through our portfolio is that we are sitting kind of across the whole spectrum. So while private equity transactions are down quite a bit, on the other hand, our private lending, which is often sitting on the other side of the capital stack from the private equity managers, are continuing to earn higher rates. You see real estate transactions down significantly, but overall the underlying assets remain relatively solid. There just isn't a market for them to exit out of. And so I think you're going to continue to see kind of this slower paced market that is underlying fundamentals remain solid, but the transaction volume is just going to take its time in recovering.
So with that in mind, again, some of these private assets, so we're higher for longer, which means ultimately on the lending side, we're probably achieving a higher rate of return than we would expect. Are there any concerns or any cracks in some of those asset classes because of the higher interest rates? If borrowers are having to pay higher interest rates for longer, is that problematic? Or if private equity funds are unable to exit deals, does that become problematic? Or said differently, does it also provide an opportunity, right? I mean, because I think we always have to think about it from that perspective. Where there is some sort of distress, there could be opportunity, right?
Yeah, absolutely. And I think that's, the double-edged sword of private lending is that while you are earning these higher rates and more money on your invested capital, that money is coming from the operations of the company and putting a strain on the company. Thus far, we haven't seen defaults tick up in our assets, but it's certainly something that I think we can expect to see some more defaults kind of across the entire asset class. And so that's something we'll continue to monitor. On the private equity side, I think it does create an opportunity where funds are reaching the end of their life. They have to exit. They have to find liquidity for their investors. And so that provides an opportunity for, an opportunistic manager to underwrite an asset and potentially come in and, buy at a price that is potentially less than economic for the seller because of their timing constraints.
Yep. No, and I think well said. And I think from our perspective, we're also starting to look at more things like distressed real estate. We're looking at bridge financing on the private lending side because, again, that's where the opportunities are now lying. And I think that's good for everybody because, again, I think it helps capital markets where there tends to be a little bit less liquidity, and it helps bridge financing for if you're a real estate developer. You need that lending to get you from development to some final state where you actually have tenants and it's cash flowing positive. So I think from our standpoint, we want to see some of these opportunities start to bubble up and start to express that within client portfolios. So again, I think it's an opportunity for sure. Well, great. Well, so that was kind of a first look at our investment committee, our new investment committee. And, we appreciate you guys joining us. I think next time when we do this, my hope is we might do something called Stump the CIO or Stump the investment committee. And with that in mind, you as clients, please send in all your questions or comments about these videos. We would love to hear what you guys have to say, and we want to have great questions to stump both Isaac and I. And we can make it a lot of fun next quarter. So we look forward to hearing from you. Thanks.